Welcome to Investing Insights. I'm your host, Margaret Giles, filling in for Ivana Hampton to bring you a personal finance episode. Tax day is quickly approaching and it's time to get organized. New tax rules might make it worth your while to itemize rather than take the standard deduction this year. And don't just file away your 1099 forms. They can offer valuable insight into your portfolio's tax efficiency. Christine Benz, Morningstar's Director of Personal Finance and Retirement Planning, is here to discuss what you need to consider before and after you file. Christine, thanks for being here.
Margaret, it's great to see you.
So we are barreling towards tax day, which is also the due date to make those IRA and HSA contributions for 2025. Now, is there a reason to wait until the last minute to make those contributions?
No, from a practical standpoint, a lot of people do. And it might be that some folks are waiting to see what their tax return looks like and use that to guide whether their income comes in below the thresholds to make an IRA contribution or whether they have the funds on hand to make a contribution. But ideally, you should hit those contributions as soon as you possibly can. So for the 2025 tax year, that would have been back at the beginning of January 2025. If you are making that 2025 contribution right now, one thing to do is see if you have the wherewithal to also fund 2026 at the same time, because there really is a procrastination penalty, as Vanguard has called it in some of its research, because it sees these contributions coming in at the 11th hour. So you do want to get the contributions invested as soon as possible, especially if you're a younger investor, because those are months of foregone compounding and those can stack up, especially if the market is good and you have that portfolio invested predominantly in stocks.
Absolutely. So part of getting ready to file is deciding whether to itemize or take the standard deduction. And we've talked about this before, but choosing to itemize might be a more attractive option this year. Can you explain that?
Yes. So the standard deductions do march upward to keep pace with inflation. So for the 2025 tax year, if you're a single filer, it's $15,750 is your standard deduction. It's double that if you're a married couple filing jointly. So that's a pretty high bar, but the game changer for 2025, starting in 2025 as a result of that OBA tax legislation that passed through Congress at mid-year, and it elevated what had been a $10,000 cap on the amount of state and local taxes that you could deduct from $10,000 all the way up to $40,000. So for people who live in those high tax states or live in a municipality that has high property tax bills, you might want to take a look at whether itemization might be within reach for you this year, because you can deduct more of those state and local taxes. One key caveat here, though, is that for higher income folks, for people earning over $500,000, that cap begins to phase out. And if your modified adjusted gross income is over $600,000 for 2025, you're back to that $10,000 threshold for state and local tax. But I think for a lot of people who had gotten really comfortable using the standard deduction, it's a really great year to take a look at whether itemizing might make sense for you.
All right. So it is a little more labor intensive to itemize. Do you have any tips for someone who wants to itemize, but they're having trouble tracking down their receipt?
Yeah. So act like you're going to itemize, I would say, on an ongoing basis. Keep a file for the current tax year, open one for 2026, for example, whether it's a digital file or a physical file, it doesn't matter, but file away those relevant receipts that would relate to your itemized deductions. If you're looking at 2025 and it's a bit of a paper chase because you weren't expecting to be on the threshold of itemizing, a great tool is to look at your credit card annual statement. Most big credit card providers will send you an annual statement that will look at your expenses by category. And that's kind of a helpful budgeting tool too. You can see how much you spent on dining out or travel and all of those things. But you can also see your contributions to organizations broken out typically as a separate line item. So that can be a really good tool as you're attempting to gather up those charitable contributions. There may be some noise in there, some things that aren't actually charitable contributions, but that's a really good starting point.
Right. So on the other side, someone who chooses the standard deduction route may still qualify for some additional deductions or credits. What are they?
Yeah, absolutely. So if you're making a health savings account contribution and you're doing it not through your employer, not through payroll deductions, but if you're making it on your own, that would qualify as a deduction. If you're making an IRA contribution and your income qualifies you to make a deductible contribution, that's another one. There's also a charitable deduction that's available for people taking the standard deduction in 2025. So it's $1,000 for single filers, twice that for married couples filing jointly. A key thing to know there is that you need to make cash contributions to organizations. So other types of contributions wouldn't qualify. And finally, a biggie is for people over 65 in 2025 can take a senior deduction. And they can take that regardless of whether they are itemizing or taking the standard deduction. It's $6,000 if you're over 65. If you're part of a married couple filing jointly and you're both 65, you can take $12,000, so double that. There are fairly strict income limits on this, though, so you need to come in below those thresholds to take that $6,000 deduction as a senior.
All right. So I want to shift gears a little bit and talk about investors.
Mm-hmm.
So they should have already received their 1099 forms, and it can be super tempting to just use them to file your taxes and put them away. But you think that there's really some valuable insight to be gained from those forms. So let's start by discussing what an investor can learn about their dividends.
Yeah, use those 1099s to up your game on investing. When you're looking at dividends, a fork in the road that you'll see all your dividends that were paid out, and then you'll see those that were qualified, count as qualified. Those qualified dividends are what you're going for, because if you have the holding in a taxable account, they're eligible for a tax rate equivalent to the long-term capital gains rate. So that's 15% for most investors. If it's a non-qualified dividend that's getting paid out to you, that's going to be subject to your ordinary income tax rate, much higher level. So that's an asset location problem. If you have a lot of those non-qualified dividends, and REITs are a good example of a security type that pays out non-qualified dividends, you'd want to take care to silo them within some sort of tax sheltered account where you're not paying that full freight on those distributions as they get paid out to you.
So capital gains are another line item on the form. What should investors be thinking about there?
Yeah, this was a pain point in my own tax return. It has been for the past few years. We have a holding in our account that has paid out pretty big distributions. It's performed really well. In hindsight, it wasn't a great holding for our taxable account. So if you are an investor and you're seeing those big capital gains distributions from mutual funds that you might hold, that too is an asset location problem. And if you want to hold that holding in a tax sheltered account, well, there you have to consider your own position, your own cost basis in that particular holding before deciding whether it's time to make a sale, because you will trigger your own tax bill if you sell to correct that asset location issue. So a couple of avenues are available in that situation. Say you have a very low cost basis in one of these serial capital gains distributors. You could just uncheck the reinvest distributions box and at least have those distributions get sent to some other holding with better tax efficiency characteristics. That's been our decision with this particular holding. We like it. We want to hold it. We have a low cost basis, but we do not want to add to the tax pain that has been going on. So people should use the capital gains distributions to inform their asset location positioning.
That's really helpful to think about. So the last thing I want to touch on from those 1099 forms is the tax-exempt interest dividend. So like what you'd receive from municipal bonds or municipal municipal bond funds. So does it make sense for everyone to maximize that tax-free interest?
Not really. So you do earn a tax break for that, or I should say you're not taxed on municipal income at the federal level if you happen to invest in a bond issued by your state or your local municipality. You can pick up additional tax savings. But if you are someone who isn't in the highest tax bracket, and I would use kind of the 24% tax bracket as sort of a rough cutoff, you're probably better off making the contribution to the taxable bond fund. You'll be better off on an after-tax basis. If you're someone who is in a higher tax bracket, run the numbers, see whether you're better off in municipal holdings or taxable holdings. There are these tax equivalent yield calculators that you can find online. Many of the major investment providers have them where you can run the numbers, where you're plugging in your own tax rate, your own state tax rate, if that's a consideration, and you can see where you'd be better off in a taxable or a municipal holding. Another thing to think about here is asset location, that from a practical standpoint, many people do want those more liquid investment types. They want bonds, they want cash holdings in their taxable accounts because they want access to the funds on an ongoing basis. But if you are in a position to silo your bonds and perhaps your cash holdings in your tax sheltered accounts, that sort of minimizes the whole headache here from a tax standpoint.
All right. So to switch gears here a little bit, it might feel good to get a check, but receiving a large tax refund really isn't a good thing. Can you explain that?
Yeah, it's just an interest-free loan that you've given to the IRS. They're not entitled or not required to pay you any sort of back interest on the amount that they've been holding for you. This is not an issue that I tend to get super excited about. If someone can save this way and can find the funds to maybe make an investment, I don't think it's the worst thing in the world, but I do think it's an opportunity to check up on your withholding. If you are perhaps under withholding, you can address that. If you haven't looked at that for a long time, and many of us haven't, check that, what your withholding allowances look like. And then if you do find yourself in this position of having a windfall, just try to use it to improve your financial position. So in some households, that might be paying down debt. It might be that you have the funds to invest in an IRA, but really take stock and use it to improve your financial position going forward.
All right, Christine, this is really helpful. Thanks for taking the time.
Thanks so much, Margaret.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen, lead multimedia editor Ivana Hampton, and associate multimedia editor Jessica Bevel. I'm Margaret Giles, lead content development editor at Morningstar. Thanks for tuning in.